Welcome to Furniture Industry News. Today is September 11th, 2024. We'll cover important updates affecting the furniture industry, including the latest on Labor Day sales, economic impacts on the industry, and exciting future plans for Bed Bath & Beyond. Labor Day sales were a mixed bag for furniture retailers this year. Some reported significant boosts in sales thanks to aggressive promotion, while others simply saw an increase in foot traffic. For instance, Tyson Furniture in North Carolina saw a 20% spike in sales due to their early promotional efforts combined with back-to-school season advertising. Similarly, Gardner-White Furniture in Michigan noted strong overall activity across all major categories, emphasizing that customers tend to wait for these big holiday events to make purchases. Key markets, particularly those experiencing strong housing developments and relocations, helped bolster these positive outcomes. All in all, while results varied, it was clear that Labor Day remains a critical opportunity for driving sales in the furniture industry. The choppy U.S. economy has significantly impacted the furniture industry, making it a challenging period for many. Over the past few years, we have seen supply chain disruptions, sudden shifts in consumer demand, rampant inflation, and changes in monetary policies. All of these factors have contributed to an unpredictable market. One of the main challenges has been rising inflation, driven by increased costs of raw materials like lumber and metal. Geopolitical tensions, such as the ongoing war in Ukraine, have further added to these inflationary pressures by driving up energy costs. Additionally, tariffs on goods imported from China have forced many companies to seek alternative suppliers, further complicating production costs. These increased costs often get passed on to consumers, but with inflation affecting essentials like food, gas, and housing, many buyers are hesitant to make big-ticket purchases like furniture. As a result, furniture sales have slowed down. Interest rate hikes aimed at controlling inflation have also made borrowing more expensive, causing consumers to delay financing home renovations or larger furniture buys. The housing market, closely tied to furniture sales, is also in flux. Higher mortgage rates have cooled home sales, reducing the number of new homeowners looking to furnish their spaces. This has led to an excess inventory for many retailers, resulting in steep discounts to clear stock, thereby compressing profit margins across the industry. Moreover, the shift to e-commerce has also introduced new challenges, particularly in logistics and supply chain management. Shipping large, bulky items like furniture remains costly and complicated, especially with ongoing supply chain disruptions. These factors contribute to longer wait times and higher costs for consumers, potentially deterring purchases. Looking ahead, there are positive signs on the horizon. As interest rates eventually lower and new home construction picks up, we could see a rebound in furniture demand. Millennials are beginning to buy homes and start families, and the upcoming generational shift of baby boomers downsizing their homes could inject new energy into the market. Though the road ahead may be uncertain, those in the furniture industry who can quickly adapt to these changing conditions and evolving consumer behaviors are most likely to thrive. Spot rates for ocean containers fell another 8% this week, continuing a trend of declines we've seen over the past month and a half. On average, rates are now at $4,775 per 40-foot container. Despite this drop, it's important to remember that rates are still significantly higher than pre-pandemic levels, when they averaged around $1,420. However, there's a looming issue that could disrupt this downward trend. A potential port strike on the East Coast is creating a lot of uncertainty. With labor contracts for dock workers set to expire at the end of the month, the threat of a strike is real and could lead to sudden rate hikes. Importers are being advised to delay their shipments until late October or November to avoid potential disruptions. So while rates have fallen, the situation remains volatile and could change rapidly depending on how labor negotiations unfold. Bed Bath & Beyond is set to make a comeback in 2025, but not in the way you'd expect. Instead of traditional store openings, the parent company, Beyond Incorporated, is forming financial partnerships with two existing retail chains. Starting early next year, some stores will be converted to Bed Bath & Beyond locations. Additionally, the company is working on introducing Overstock.com into physical retail spaces. This new approach allows Bed Bath & Beyond to return to the retail landscape without taking on lease or inventory liabilities, making it a strategic maneuver in today's challenging market conditions. Hooker Furniture's latest quarterly report was a mixed bag. The company reported a 2.8% decline in Q2 sales, marking its second consecutive quarterly loss. This comes amid a broader effort to cut costs, including the announcement of 44 layoffs, which they estimate will save around $6 million annually. CEO Jeremy Hoff mentioned that the layoffs, although tough, were necessary and mostly came through early retirement packages. Despite these challenges, the company is optimistic about future performance, particularly in their home meridian segment. This segment showed promising signs with a 5.6% increase in net sales compared to last year, driven largely by strong performance in its hospitality division. Although Home Meridian still reported a loss, it was significantly lower than previous quarters, indicating a trend towards profitability. The company has also taken steps to consolidate operations, such as reducing their Savannah warehouse footprint and restructuring underperforming divisions. These moves are part of a larger strategy to save $10 million in fixed costs by the end of the fiscal year. Overall, while the short-term outlook reflects some turbulence, Hooker Furniture's strategic adjustments and gradual improvements in key segments suggest a more stable and optimistic future. Big Lots is set to be delisted by the NYSE following their voluntary Chapter 11 bankruptcy filing. This decision comes amid financial instability and an agreement to sell the company in a court-supervised auction process. The NYSE cited uncertainties about the ultimate impact on Big Lots' stock value as a key reason for the delisting. Prior to the suspension, shares were trading at just under 50 cents. While the company had the option to contest the NYSE's decision, they chose not to appeal. Keep an eye on how this situation unfolds as it impacts vendors, creditors, and the overall market. Thank you for listening to Furniture Industry News. If you enjoyed today's episode and want to stay informed about the latest happenings in the furniture industry, be sure to hit that subscribe button. By subscribing, you won't miss a beat on crucial updates, market trends, and industry insights. Until next time, stay tuned and stay informed.